So I think last time we spoke was 2 months ago. You were cautious then. I know about a month back, you've turned largely constructive. How do you feel about equities right now?
I mean, right now, the sell-off has been driven by investor sentiments. And if we look at the PMI figures, we look at the outlook and the deterioration or deceleration of global growth environments, and obviously bond yields, Fed outlook, right? We think the market sell-off has been overdone. We think the sell-off is purely driven by a lot of pessimism. But if we monitor the pessimism, how far it's been, in the United States, which is the center of the sell-off, we saw that the AAIR investor indicator, a sentiment indicator, suggesting that they have never been more bearish in the last 12 years, and which typically, unless you get a recession happening imminently, we do typically get a rebound. Here in China, whilst we still have the debate about how zero COVID policy is going to impact economic outlook, but what we are seeing is the number of cases has been falling, the number of cities that's been locked down has been fallen from a peak in early April from 40 cities to now 31 cities. There's no magic crystal ball to say, okay, it will be done in the next month or two. But the developments so far, despite the lockdown, have been increasing even in Beijing in the last couple of days. We are seeing good signs that we could, by the end of June, be on a path of unwinding lockdowns thereafter. And the economic outlook in the current trajectory is that the majority of the downside would happen in this quarter. But for the second half of this year, if our base case scenario anticipating that the lockdown could begin to, exit for the second half of the year, then recovery will start to take place. And then we ask ourselves, where should markets be when the lockdown beginning to unwind? Right? So we are still optimistic. We think it's oversold. We think there is some room for some recovery right now.
Oh, okay. And what gives you that degree of confidence that the base case should be that from June, things are going to reopen? And how do you define lockdowns, by the way?
Okay. Well, right now, about less than 20% of the economy is locked down. If you calculate by the percentage of GDP that cities are locked down, these 31 cities, we are looking at somewhere close to 12–15% of China's GDP. Okay, we look at that from a retail sales perspective, that's less than 20%, I think 18%. We look at this from an export perspective, that's less than 20%. Yes, there will be some disruption. And then we ask ourselves, what is the scenario where lockdown will continue? What's the probability? If you lock down a city like this for, 4 weeks or 8 weeks or 12 weeks, is it not going to contain the virus? How is that possible that it will not contain some level of the spread of the virus, right? So, if we ask the question another way around, okay, well, actually, it's going to have a good impact. It happened, it worked in Shenzhen. It managed to bring cases down in Shanghai. And it will likely do so for the same in Beijing. Beijing numbers are below 100. So we do think another side of the scenario is probably also unlikely.
But Shanghai is still, in effect, locked down, though, even if cases have come down. What I'm trying to get to is when you look at these markets that are really trying to figure out, I think there's no debate when it comes to the economy and the impact there. Let's make that clear. When it comes to the market, though, people are trying to figure out, can this market rally sustainably, Jack, as long as this COVID policy is in place? And what are you telling your clients the answer to that question?
Well, our view is the market could first start with a rebound. But secondly, we will need the recovery or at least the stabilization of the global equity markets. And what needs to happen now is some stabilization in bond yields, some stabilization to be of the Fed outlook to be fully priced in. And when we look at the situation in terms of global liquidity and monetary market policy, the Fed outlook is pretty much baked in. The 50 basis point hike in the next meeting and the next meeting are baked in. The 25 basis point after that is baked in. And then now the ECB have become more hawkish. And we do anticipate them to start hiking in July and thereafter and taking interest rate by the end of next year to 1.25%. And that's a lot in the price. And secondly, what we need to see is some stabilization in bond yields. In the near term, we think Treasury yields will be stabilizing around the 3% area for now. But by the end of the year, we do see it rising towards the 3.3%. But in this path, as market become, I guess, more used to a stabilized treasury yields in later part of this year, we think equity market will be more stabilized. And thereafter,
Okay.
we will see a more optimistic China outlook. And that obviously for the second half will depend on the stabilization of the Chinese economy and also the stabilization of the yuan, which we think could take place below the 7 mark.
Okay, in fact, to your point there, Jack, we just hit 6.8 on the onshore yuan. You think we go beyond 7? And how do you hedge that? Because hedging seems a bit expensive at this point.
Yeah. Right now, I mean, with the yuan already down 5-6%, right? If we look at the factors driving the yuan, it's really been a dollar story. The dollar strength have been driving most currencies lower, and the yuan was not spared. And the PBOC, I guess, last month decided, okay, given the export hits that they will likely be experiencing in April, May, and June time, and given the risk of some outflow that's happening, that's driving some renminbi weakness, we think that PBOC is more open-minded for some two-way volatility in the renminbi. But going forward, the key driver to the renminbi is really to do the dollar strength. And we look at the dollar strength right now. I mean, is anyone really going to be chasing at this moment the dollar strength after the, I guess, some 15% rally in the last 1 year? We think we are due for some consolidation soon. I don't think at this round that the renminbi would break the 7 mark. We would likely see some two-way flow and two-way trading once we reach, I guess, next few days. And then thereafter, after the rebound, we do recommend that to take advantage of that rebound and start hedging the renminbi. Because looking beyond the 12 months, right, the current account surplus in China is likely going to start the, I guess, eroding slightly, given it hit a record high in the first quarter at the end of last year. And that's driven by, Western consumers switching from goods demand to services demand as people live with COVID. And secondly, if we look at the inflows of bond market, the bond market rebalancing of, in global sovereign bond indices is coming closer to an end in a year's time. And thereafter, inflow for Chinese bond will begin to slow. And that will leave us with less support in terms of capital inflow for the renminbi. And we think at that point, the renminbi doesn't need to be at the expensive end of the currency basket. They can allow it to come back to neutral and normal side. And we think at that point, renminbi will be due for more downside.
Okay, Jack, what I'm hearing from you is longer term things are going to be okay. The question really is what I do these next 1 or 2 months. And for investors, if I have cash right now, what do I do with that? Do I sit in that cash or do I deploy it in this market?
Okay. Well, first on equities, right? We are overweight U.S. and China equities, and we do think at this point in time, sentiment is too pessimistic, and we do see opportunity for investors to participate in the Hong Kong China equity markets. And this 1 to 2 months, we could see some stabilization in sentiment and therefore some rebound. And remember, we are looking at a period where the PBOC and the central authorities are likely going to be announcing further stimulus to the economy, targeting the SMEs, targeting infrastructure. And there are sectors that would directly benefit in this environment. And secondly, whilst the internet stocks have been, I guess, falling in the last one alongside global equity markets. But what's likely to happen is, with the zero COVID lockdowns happening, there will be some added momentum in terms of being biased to the work from home or the, I guess, internet platform for the short term. And secondly, we are waiting for further announcements from the government in terms of details of how they're likely going to pause regulatory crackdown. And we also heard that on the China is beginning to give way to the US regulator to allow some companies to disclose data and audit. And we think that's all positive news for China equities for investors in the near term.